Good morning and welcome to Markets Now. I'm Michelle Rook along with Darren Newsom with Bar Chart, and we saw a mix to a little bit lower start here in the grains this morning. Cattle setting back. You've got hogs mixed, and then in the outside markets, after the CPI numbers coming out, we do have the Dow and the equities sector back lower. Crude oil was lower before that. And Darren, let's talk a little bit about the CPI numbers. First of all, inflation cooling just slightly in January, but we are still not slowing down enough here, are we?
No, we're not. And so the situation really is unchanged. We're going to continue to see interest rate hikes, probably still the same variety, 25 basis point moves. I don't expect the U.S. Federal Reserve to come in full bore and go back up to 50 basis point moves anytime soon. I don't think it's that hot of an inflation market. But we're still seeing higher prices. And so we're still going to see interest rate hikes over the course of 2023. That's just the way it is. So really no change in the sentiment, no change in what the approach should be, or the overall strategy.
So there are some thinking, though, 6.4% on the CPI, like you say, inflation still running pretty rampant here, but certainly the market has been looking like it's thinking that we're going to slow down some of these rate increases as we get into 2023. But you don't think that's really going to happen then?
Yeah, I do. I still see the dollar in a long-term downtrend, and only because we built in such high fears of inflation that the dollar skyrocketed, that we were just going to see these 75 basis point to a full 100 basis point moves just continue, and it's just not going to happen. So I think we're going to see consistent rate hikes. They're not going to be huge, but they're going to be consistent, and it gives the dollar some room to move lower. Whether or not that has an effect on commodities in general, or dollar-backed commodities, is yet to be seen.
The other outside market that we're watching here is crude oil. We had a big up week last week, but we're down this morning, and the Biden administration says they are going to release another, 26 million barrels from the SPR. And so talk about the dynamics that we're seeing in that market, and whether you think we're going to continue to see prices move over the $80 mark or stay above that level going forward.
Yeah, this was a story that, I had some phone calls about. People could not figure out, why this would happen. Well, I had to do some research on this, and this was Congress mandated. This has been in place for a number of years. And so we've seen it in February's past, where 25, 26 million barrels are released from the Strategic Petroleum Reserve. Department of Energy was arguing against it this time, but the Biden administration went ahead and said, okay, we're just going to stick with the mandate. And so that's where we are. Put a little bit of pressure on crude oil. Now, the interesting thing about crude oil is, long term, it's still fundamentally bullish. We can see that in the inverted forward curve. But in short term, we have seen the nearby contract get down as low as just over 71. I think it hit like 71.10 back this past December or something like that. Technically, from a technical point of view, that completed a three-wave long-term downtrend. So now we could start to build a bottom in this market. I know the idea is to, we've moved the range down for refilling the SPR from, I believe it was either 80 or 81. Now it's down to about 70. And I think that's overshooting a little bit. It sounds like a trader who may be going to the well once too often. I don't know that we can get crude oil down to 70 this time of year, with spring and summer driving season coming on. Could be difficult to pull off.
Gotcha. Let's move over to the grains, soybeans and meal, both seeing some consolidation here this morning after soybean meal closed above the $500 mark for, I think, the first time in the history of that particular contract. But have we got all of the Argentina crop losses kind of figured in here now, or not?
One would think so. Again, we have a very strong inverse in this market. As you mentioned, we have new all-time highs, historic highs, contract highs, however you want to look at it. But both soybeans and soybean meal finished Monday backing off from those highs. So, we saw it run out of gas a little bit on Monday, certainly a little bit of follow-through selling overnight through Tuesday morning. Now, what's interesting here is it's not commercial traders putting pressure on this. We're not seeing spreads really react, saying commercial traders are starting to dump this either market. In other words, we've just got some fund selling. This being a Tuesday, not overly surprising. See them position themselves a little bit. But fundamentally, these markets are still bullish. And until we can actually change that, until something changes in the supply and demand situation, I don't see either market breaking hard.
Yeah. And as you point out, we hit chart resistance not only in soybeans after taking out the January highs, but we did the same thing in the corn market. And I
Mhm.
guess my question now on corn is when do we start noticing here some of the crop problems that we're having in Brazil, especially getting the safrinha crop planted and the slow soybean harvest that we're seeing in the north?
Yeah, we've seen it in the corn market for the last month and a half at least. If we go back to January 12th, we saw the May July corn future spread take out its previous high of 7.75 cents inverse, and it was pushing 14 cents inverse overnight. So market's been screaming at us that there's a problem, and we're just now starting to hear whispers of it, outside of the market arena itself. So we know, or we've known, that the world, that the commercial side is concerned about how tight the U.S. Supply and demand situation is going to get. And it just seems like right now everyone else is starting to catch up with that.
You bet. So is that safrinha corn crop in Brazil, is that the one thing that could push this market back above the $7 mark? Or do you think that we're going to need a export demand push too?
That's going to be the key. At least theoretically, that should be the key. Are we going to see exports pick up? We saw unshipped sales in the latest weekly export sales and shipments update climb to 543 million bushels. That's still a small amount, but up 30 million bushels from the previous week. So we're going to have to see some sales start to being made. But do we have any corn to sell? I mean, that's the biggest thing. If we're going to continue to feed the number of cattle that we are, if we're going to continue to see ethanol demand as we go into, again, the spring and summer driving season, do we have much corn to export to the rest of the world? I think it's going to be a key issue.
We just kind of mixed here this morning, Darren, after we had nice chart breakout on Friday, a little follow through buying yesterday, and we've had a pretty good run off of the lows here now. But do you think we have enough either war and or weather premium put into this market yet?
Not in Kansas City, hard red winter. We do see an inverse in the July September spread. I don't think it's enough to account for the crop damage that's being done. We'll have to wait and see when that crop comes out of dormancy. The big moves recently have been in the Chicago market, and while it looks to be commercial buying as March is gaining on the May, to me, this is nothing more than non-commercial short covering. I think that's the driving force. This group held a very large net short futures position a couple of weeks ago, or a few weeks ago now. We haven't gotten any updates recently, but you can tell by market action that some of the short covering has been going on. I don't see that the fundamentals in soft red winter have changed all that much. I don't see a huge uptick in demand right now for U.S. wheat, particularly soft red winter, but certainly something to watch. But to me right now, the market is being driven by some of this short covering.
And what about the cattle market? New contract highs again yesterday in the live cattle futures pushed by the higher cash. Today we're setting back. Is this just some routine profit taking in an otherwise bigger bull market? I mean, do the funds or, the longs in this market continue to defend that position?
Yeah, they've been fighting hard with this. Future spreads still tell us that we've got plenty of cattle. Everyone wants to point to the changes from last year's cattle on feed reports to this year's. Yeah, we're comparing it back to some record large numbers last year at this same time. So we still have plenty of cattle on hand. Future spreads are still bearish, but we can't get the market to break. And that's usually important. It tells us the market is, traders are willing to defend it, mostly on the non-commercial side at this point. And then we'll see. We'll see if the cash market can continue to go up. We don't normally see cash follows futures, but that's certainly been the case here recently.
All right. Thanks for joining us, Darren Newsom with Bar Chart, and that is Markets Now.